reliable data, I'll talk about that, consistent benchmarks, and then also timely results. Because we all hear people say, oh yeah, I just looked at that indicator and it said 2 months ago that we began a bear market. Oh, that's real helpful if you're already in the midst of it. But, oh, and by the way, I should have brought this up. If anybody would like the notes from today's lecture, I did bring several copies of them. I see you're right in there. If you like, I'd be happy to provide them to you. And obviously the book has a lot of this in it. But I do like what Mark Twain had said so many years ago, and he's so right. It rhymes, but it does not repeat, but it rhymes. So don't think we're going to come up with some magic indicators today. It's more of an awareness of this background noise that's going on, or as they're calling it, digital repeat, that we hear so much about. So let's jump in here. Let's talk about the problems. So I call it phantom figures, and I'm sorry for the little charts, but I'll talk about this in a moment. This was a download. Now, many of you here probably know about Bloomberg, your former mayor, and certainly runs a huge company. But a lot of us are dependent upon getting these downloads of data from firms. So let me show you what we're looking at here. This is a download that I just did 3 days ago from Reuters with data that came from Dow Jones for the Dow Jones bond and stock averages. Okay, simple enough, right? I want you to notice the week of 9/11. Now, as you probably all remember, tragically, Wall Street was closed for business. The world was closed. Yet somebody at Dow Jones decided that for the bond average, we're going to go ahead and put data in for 12, 13, 14. It's phantom data. Same prices. Now look at, whoever did the Dow Industrial Average did it properly. From 10 to 17, there was no data. Here's my problem. Unless you know to look for that and know that for some bizarre reason, the Dow Jones bond average has 71 additional data entry days in it than the Dow Jones Industrial Average. Imagine you're a historian and you want to do comparative analysis to bonds and stocks. It doesn't line up. It does not line up. And by the way, I just went back to 1997. I can show you a lot more than that going back further. Here's my point. This is the scary part to me. The digital age, we've entered a world where speed and convenience is better than accuracy. Let me give you one other part to that. I actually knew about this error. I can show you many more. They have data for Thanksgiving. They have data on weekends. I mean, Martin Luther King Day. It goes on and on and on. It's just lazy behavior. I know when I first started in this business, I was a junior analyst at E.F. Hutton. My job was to scrub data. It was a boring job. Guess what? I'm now president of an investment firm, chief investment officer. Guess what I spend a lot of my time doing? Scrubbing data. You have to you have to get underneath the hood. But when you think about Bloomberg terminals and you think about all these amazing systems that are out there, but you can't fix the data. You can't, in the old days, we used to call these things dumb terminals. You can't go in there and fix it anymore. So we are now in this world where accuracy does not matter as much. And I just dare say that it makes me a little nervous that people could be making decisions based on faulty data. Let's jump ahead here. I think it's safe to say the folks at Standard & Poor's don't like me too well, because I wrote an article in Forbes, a year ago, Mark? I think I wrote this article about a year ago, and I basically put that the S&P 500 and the Dow Jones Industrial Average were built for marketing, and I dare say I question their validity as a legitimate benchmark. We just went through having our track record audited. It's called the GIPS protocol, GIPS verification. And they're now going to start requiring that for benchmarks. And what I mean by this is simply that I think when you start having investment products bouncing off of benchmarks, I think there's a tendency to kind of forget that your need to be a proxy for the market is now superseded by the need to sell your products and to license your indices. So here's a quote from the article, and many of you might be surprised to know this. But if you just went back to 1999 and looked at the S&P 500, which, by the way, remember what it's supposed to represent: large cap U.S. traded stocks. Not the Russell 2000, not the S&P microcap. Why were there 263 changes in a short period of time? And of that, 68 of these companies have been around a long time. They have been in business. I believe what has happened is that there's a tendency to lop off the poor performing parts of that index, although I would argue, Clint Eastwood's one of my favorite actors, that movie The Good, the Bad, and the Ugly. When it comes to benchmarks, you got to leave the ugly in. People own those stocks. But we're constantly lopping it off, and I think that in some ways it's causing a statistical bias called survivor bias. It's also skewing the averages. So here again, I think that we have to ask, what is a reliable benchmark? So if you're going to study history, you've got a big problem. You might have bad data and you have indices. It's kind of, do you all remember Coca-Cola had old Coke and new Coke? Remember that thing? Back, I'm dating myself, what was it, 30 years ago? Well, different flavors. It's the same problem with indices. And then I still love to ask this question, can anybody here honestly tell me why the Dow Jones Industrial Average has no mining stocks and 2 credit card companies in it? I have to say Charles Dow is probably rolling in his grave. It doesn't make any sense. Oh, and by the way, several of the components in the Dow Industrial Average haven't even gone through a full economic cycle. Oh, and then final thing on the S&P 500, there's actually 501 companies. They have 2 shares of Google in there. So again, I raise these questions. I don't think, can you take those and take them back in time and say that's really how the market acted? I don't know. I question it. Now, when I went back and I was writing my book, certainly several of my books, and I went back and I looked at past interviews, and I've done a lot of media. You don't always remember what you say and when you do, but historical comparisons do work. Now, this was a piece that I sent out to our clients January 15th, 2008, and I was literally doing nothing but looking at past bear markets and saying, look, when you look at it on stocks, real estate bonds, this is breaking down. Now, I did not know, nor did anybody else know, there was going to be nearly a 50% correction in the markets within a 12-month period of time. But you just knew the storm clouds were there, things were breaking down. And by the way, there's not Ouija board stuff here. It's looking at things like advanced decline lines and volume levels. And you could just see that bear markets set up very much the same way historically as they would today. The other part was this. I remember talking to this article. I don't know if any of you here ever read the Wall Street Transcript. It was an industry publication done for a very long time. But the premise of this talk was about what post-war markets look like. Now, this was, people talking about, why is the market doing what it's doing? I say, we're still in a post-Cold War era when, we won the Cold War, and there were a lot of things. But remember that even in those periods of time, you have steep pullbacks. But I did nothing but take a look at the golden era after World War II, looked at the post-World War I run in the Roaring 20s, as it was called, and I put it on top of where we were at that point in time. And I wish I had remembered that I said all these things, because probably I could have sold a lot of magazine articles back then and probably should have been a little more aggressive in the market. The point, I'm not trying to pat myself on the back here. I'm just simply saying, I think that our track record and certainly what I've written about in my book and my articles proves that history can be of value, and we should try to use it. So we actually wanted to complete the complete Mona Lisa of the financial landscape. And I know that sounds a little weird, but these are the 6 major areas of investing since 1900. Now, notice there's no scale, no date on them. We just wanted to make sure you knew that compiling that, such as indicators like preferred stocks, even real estate. We have the only real estate index that goes back to 1830. To complete that landscape, we actually physically had to go in there and compile the indices. So here we're going to go onto a little name that investment quiz. So here you go. Pick the color for stocks, corporate bonds, 10-year treasuries, housing, preferred stocks, and commodities. So you guys thought you were just going to have to passively just sit back and absorb, didn't you? As David said, I'm also a professor. I taught for 6 years, so I have a lot of fun. And by the way, I do this with my clients as well. I make sure they learn something. So anyway, hey, you got it all down? Everybody have some ideas? All right, so let's go to the next page. There you go. So common stocks. The surprise most people have are preferred stocks. Any of you here ever own preferred stocks in your own portfolios? That's interesting. So 3 of you out of a pretty good sized room. Actually, it's funny, when Mark and I first met, my business partner and my friend, one of my first books was a book on preferred stocks, and he said, why would you bother to write a book on preferred stocks? They're the most boring thing. This was right before, obviously, all heck broke loose and the government started buying preferreds when they were bailing out everybody. But it is interesting that, first off, most people would not guess that U.S. homes. Now, I know, I hear this from realtors, yes, but you're not counting the Hamptons. You're not counting Marin County, California. You're right. And you know, when I talk about the stock market, I'm not just talking about tech. But nationwide housing is below common stocks, preferred stocks, and corporate bonds. 10-year bonds coming lower. And then as the CRB index, this is just a basket of commodities. But what we do learn, and what our ancestors actually knew quite well, you don't buy and hold commodities. You trade them. That's why they call them commodity trading advisors, not commodity investment. And ironically, a lot of hedge funds have learned this lesson the hard way. You trade, you do not buy and hold in that world. Okay, I'm sorry for the little numbers. I thought everybody here had LASIK surgery on their eyes so you could all see it just perfectly. But the point on this chart is that when you are making comparisons of various asset allocations, there's two mistakes that are often made in our industry. One, they only give you one time frame, and two, they often pick these very obscure time frames. Have you folks ever noticed you get an ad or an email blast? Since May of 1998, our portfolios have. First off, I question anytime I see these odd time frames, someone's cherry picking. But number two, I think you should go all the way back from 1900, 1960. You take it forward and come up with what's a reasonable time frame. I'll cover this more in a little bit later, but the point being, don't think there's just one series of data to look or data points to look at. Try to cover it over a complete time frame. Okay.